So, as I'm sure many people in this room are aware, we've recently seen the development and rise of this market for so-called non-fungible tokens, or NFTs. A large set of these represent claims on either digital artwork or digital collectibles, some of which have sold for seemingly absurd values of money. So here I have a few examples and their associated price tags that they traded for. So traditional companies have gotten in on the NFT craze as well. We see that many have started issuing their own NFT collections. And we say, putting aside this massive growth and kind of craze of the NFT market, we believe that this is an interesting market to study as finance researchers. And that's because if you look at the market for NFTs, it's a market where there's millions of distinct objects. Public information about any given one of them is relatively limited, and there's also low entry costs. And this is the type of market that we've seen and studied in finance before. I would say that markets such as housing, venture capital, and of course the art market share some of these features as well. And in prior empirical studies in those settings, as well as associated theory work, we should expect that in markets like these, experienced investors or more informed agents should perform better. And so that's our hypothesis here, that experienced investors are going to have a large advantage over inexperienced investors in the NFT market. And we're going to take this hypothesis to the data and ask the question, first of all, do they outperform inexperienced investors? And if so, by how much? And also, importantly, why? So to do this, we first build a comprehensive data set of NFT collections, as well as their associated transaction data on the Ethereum blockchain. And I'll talk a lot about the data today because this was definitely a big effort to put this together. And as far as our headline finding goes, just really jumping to the point here, we document that experienced investors earn on a per trade basis, on average, 33 percentage points higher returns. And just through a little bit of context, or maybe just for some comparison here, those studies that I mentioned before that studied such as housing markets in BC, this number, 33 percentage points per trade, is a massive number, just way above orders of magnitude what we've seen in those other markets. So once we've established this, we want to understand better why. And so we dig into this, we try to decompose this return outperformance. And there we find that most of this can be explained by the fact that these experienced investors tend to participate more in the primary market. The rest of this outperformance seems to be due to the experienced investors' ability or superior ability to pick within these NFT collections. And we can see that directly in the return data and our return analysis, but we can also see this through some other channels, namely that if we look at the NFT collections that are more heavily purchased by the experienced investors in our data set, these are collections that are more likely to sell out in the primary market, more likely to sell out faster, as well as their collection price appreciates faster in the ensuing period. So as a big picture takeaway, our evidence suggests that the NFT market, there's substantial informational asymmetries and a lack of a level playing field. All right, so I want to make sure we're all on the same page in terms of understanding what an NFT is and some of its key attributes. So NFTs are they're digital assets. They're held in blockchain wallets. So the ownership of an NFT can be verified if you know the public wallet address. But if you want to exchange or trade in any of these NFTs, you need the private key in order to actually make those types of transactions. Now, as the name suggests, in contrast to other types of crypto assets, NFTs are different in the sense that they are unique as well as indivisible. So NFTs are often traded on these online platforms or exchanges. And so here I have a screenshot from OpenSea, which is one of the most popular NFT platforms. And here we can not only see what a user would see, where you can browse potential NFTs to purchase or bid on, but this also gives you a sense of also the type of art that's actually underlying or associated with a lot of these digital assets. And I'll show some more examples moving forward as well, just to give a little more concrete idea of what we're really talking about here. So why do people buy NFTs? Right, that's an important question I think a lot of people have been asking. A lot of people have asked me the same. And our view is essentially that NFTs represent a digital status good. And one way to see this is, I'm going to give this example of a recent development on Twitter, where you're now allowed to use an NFT as your profile photo. And to show how this works, on the left here, we have the profile. Middle? There we go. We have my co-author, Anthony Zhang, who has opted for the traditional profile picture of himself, not in NFT. And as a result, the border around it is a circle. Now, this profile on the right, this person has opted to use their Bored Ape NFT as their profile picture. And so what's different here? Well, you see that the profile picture is in a hexagon instead of a circle. So in this setting, why is this a digital status good? Well, this profile on the right is basically telling to the world, I own this very expensive NFT, and I can prove it because Twitter is able to verify in my public wallet that I actually do own this NFT. Right, so digital status goods, these kind of verifiable signals of wealth is just one way to think about this. Another way is the fact that NFTs themselves often serve as a ability to join either online environments or even give you access to in-person events as well. And so this is another area where having an NFT affords you this type of status as well as access to certain events or certain groups that people find valuable. And this could either just be things like chat rooms or Discord channels, or you can also, some of these NFT collections are proposing that they're building these metaverse virtual worlds where the NFTs themselves will also presumably have some sort of utility value. So this durable digital status good, this is very much the kind of utility argument of at least what NFTs are offering. But let's not forget the beginning of this talk where I mentioned that there's been this massive growth and huge returns in this space. And it's not hard to imagine that this is going to attract a lot of investors who are interested in speculating in these speculative assets. Right, so high returns is also no doubt incentivizing people to participate in this market. So let me tell you a little bit about our data, just give kind of a brief overview. So we focus on a set of nearly 700 generative, or what we call generative collections. So these are essentially large collections of NFTs where each item is a variation on a similar theme. And I'll show another specific example coming up. Now, that's not the only characteristic. We also require that they have a centralized contract, that they engage in their primary market sale, where they have a website where a potential investor would go to that website and try to purchase an NFT. And what they actually get is a random object from the collection. Right? And so we have a few other conditions as well. And the reason is that we want our analysis to be focused on NFTs that are basically comparable to each other. So we want to compare apples to apples. And NFT as a term can refer to a lot of different types of digital assets. So we're focused on kind of a particular type of NFT and a particular type of collection. Now, in order to get to this collection, we had to review a large set of NFT collections that at the time we considered the universe of NFT collections back in the fall. And from there, we isolated our group of about 700 generative collections. Now, despite being a relatively small share of collections in terms of count, they do represent nearly half of the primary market volume in the fall. And I think in general, when you think of NFTs, a lot of times you're thinking about NFTs from these generative collections that we study. So we get collection level information. We manually gather this from essentially from various websites. So we know information about what's in the art. We know information about the company, whether or not they post a roadmap, a lot of things. And we're going to use some of this information later in some of our collection level regressions. But then importantly, we also have transaction level data. All right. Yeah, no problem. So we also have transaction level data from the Ethereum blockchain. All right, so let me tell you a bit more about this data, because this is really going to fuel our returns analysis, which is really the core of our paper. And so there's about 6.1 million transactions. These represent all primary and secondary market transactions, where we've recently updated our data through March 2022. Now, I should mention or be explicit, these are all on-chain transactions, right? That's a limitation of working with the Ethereum blockchain, is that those are the only ones we observe. Now, within each transaction, we give a lot of information. So we know the day that happened, the price, the associated fees. This was important because our previous data set didn't have these, but now we have them. So all of our analysis is going to incorporate this. And of course, who the buyers and sellers are as well, which we're going to use to identify experienced investors. So there's a term I want to define here, which is mint. So mint is the, I guess you could say, industry specific word for when you create a new NFT, or when in the primary market, you actually buy a new one and it's minted to the blockchain for the first time. And so we see about half of our transactions are mints, and the rest of them are secondary market transfers, which occur through those platforms such as OpenSea that I showed you before. Okay, so I promised kind of a more concrete example just to keep in the back of your head. And so the example we chose to use is Subducks. Now, this was a collection that is relatively successful, right? So this isn't a randomly chosen one. They minted in July of 2021. There were 10,000 items. And as you can see in these pictures, they're all variations on a cartoon duck. Now, another thing about this picture that I want to highlight is that these are actually select items and associated prices paid for them on a given date. And we see here something that I'm going to show formally soon, which is that within collections, we tend to see that a lot of the items trade around kind of a centralized price. Meanwhile, you'll have rare ones that tend to trade for much higher prices. So here's a picture showing you what the primary market sale for Subducks looked like. So I mentioned that this was a successful collection. It was in July of 2021. And so here the gray dots are mints, meaning that these were people buying new items. And we can see that there's actually 3 different prices that people paid for mints. And this represents a tiered pricing structure that this collection would happen to use. Now we see that secondary market trading starts almost immediately during the minting period, because once you've minted your NFT, you could feasibly trade it to other people. But we don't really see that the price of these items jumps until towards the end of the sale. And so this highlights what we think is an important point, which is that if the minting period is still going on, there's no reason to pay above mint price for an NFT on the secondary market if you could just go mint a fresh one, unless, for example, you thought it happened to be a special one. All right, so that's just an overview of just the data itself. And now I want to tell you about some stylized facts about this market. So the paper has a lot more than this, but I really just want to go over the key things that you need to know about to really understand and hopefully appreciate our empirical results later on. So I'm going to talk about a few different markets and just highlight a few stylized things. All right, so if you look at the primary market, one thing you immediately notice is that the outcomes themselves are pretty bimodal. So on the left-hand side, this is a histogram where the variable is number of items minted out of the intended supply. So something I forgot to mention before is that these collections also have a predetermined supply of NFTs that they're planning to mint. So it's essentially a measure of success, and the term in the industry is if you sell all of your items, you've minted out. So we see that about half of collections mint out, right? So for the theorist out here, if your assumption is half good, half bad, this is not that far from the empirical truth. And then we also see a large set of collections more towards the bottom of the spectrum, basically that failed or did pretty poorly in the primary market. Now, it's also pretty easy to see just visually that this primary market success, minting out, is also associated with secondary market price growth following the selling period. So speaking of secondary market, we have this data where we observe all the prices of all the secondary market transactions. And so one of the things we do in this paper is we just regress the log price for any given item on any given, or for every trade on collection time fixed effects. Right? And so when we do that, one of the things we find out is that most of the price variation, and this is measured by the R squared, 80% is explained by just GC date fixed effects. Right, so this highlights the idea that collections tend to be moved together in their prices, and then also that the daily price movements at the collection level explain a lot of the variation in prices in the first place. Now, if you plot the residuals from this regression, you also see a distribution where you see kind of a fat right tail. And this represents the idea I mentioned earlier that within any given collection, there's going to be some rare items that tend to trade for a lot more than the rest of the collection. So collections are essentially groups of kind of homogeneous items within the collection, as well as a small set of relatively rare ones. And we take these two stylized facts together and we use it as a justification where when we do collection level price analysis, we form our price index as the 25th percentile price observed on any given date. All right, so now getting towards the kind of experienced part of this paper, the investor side, which is going to be the focus of our empirical analysis. Let me tell you a little bit about the investors in our data set. So we observe about 540,000 unique wallet addresses, and this is only within our kind of GC sample universe. And it's pretty clear when you look at the transaction data that both the minting and the trading is pretty concentrated. This echoes some of the points that Antoinette was making earlier in the Bitcoin market. And I think this is a feature of a lot of crypto markets. So we see, for example, that as of the end of the sample, 50% of all the mints that were done so by wallets that had minted from 6 or more collections. On the secondary market side, about 50% of the trading is done by wallets that had traded within 10 or more collections. So we're going to define experienced investors as those that basically exceed both of these cutoffs. So they're active in both the minting and the secondary market. And if you're using the full sample, so kind of doing this exercise as of the end of our sample, you'd see that this results in about 16,000 wallets being designated as experienced, which is about 3% of the total. Now, I want to be clear here, especially because the version we have online right now doesn't use the ex-ante version for everything. But at this point now, including our return analysis, we're going to be using a time-varying ex-ante classification to determine who's experienced and who's not. And essentially, as of any given date, we look at the prior trading activity up through the previous date, and you basically follow the same exact method to determine who's experienced and who's not. All right, so now to our empirical analysis. So here I just have a summary, a brief summary, but that really just hammers home the main findings that we have. So first of all, our headline finding that experienced investors outperform inexperienced by 33 percentage points higher per trade. We're going to show this on the next slide. And importantly, this is going to be controlling for holding period. I'll talk about that in a minute. And then when we try to decompose this, we see that about 80% of this outperformance we can attribute to just the fact that these experienced investors participate relatively more in the primary market. And the primary market is where we tend to see a lot higher returns. So this can explain a lot of this outperformance right away. Now, the rest of it, we argue, is due to the fact that experienced investors appear to pick better collections to invest in. Well, how do we know this? Well, we have some evidence within our return analysis that directly point to this. But we're also going to look at some collection level evidence to support this point as well. Now, one interesting finding that may go against some of your assumptions here would be that we actually don't find any evidence of outperformance just focusing on secondary market trades. So these experienced investors aren't necessarily doing better at picking items, or at least on average, at picking items and buying them and selling them in the secondary market. Okay, so our framework, we first need to define our return measure. And so here's our measure of realized return. So we have a realized return to investor I for trading item J in collection C on time T that was purchased at time tau. It's defined as the price that they received minus fees they paid. So we're able to know how much royalty fees that and also transaction fees they have to pay in the sale part. And then you subtract off the price they paid for it, also subtracting off the original gas that they paid in their original transaction. So this is something that's new, part of our expanded data set. So basically our results compared to our current online version, they're very similar, but here we're actually incorporating and everything's going to be including fees. And this is all divided by the original purchase price plus the gas paid at that time. And so our regression, we're going to follow a regression where our key variable of interest is going to be this experienced seller dummy, just who's actually selling. And we're also going to have controls for holding period of the position, collection fixed effects, time fixed effects, and in some cases collection time fixed effects, as well as even some specifications we use item level fixed effects. All right, so for our first main finding, how we get to our headline finding. So something that maybe we should kind of highlight earlier, because it's kind of interesting, that if you just took a unconditional average, essentially, compared experienced investor returns to inexperienced, you'd actually see negative outperformance or not outperformance, right? And that might be confusing at first until you recognize that experienced investors tend to hold their positions for a shorter period of time on average. And so when we either control for holding period using just log days until they realize their trade, or in our preferred specification where we use buy date by sell date fixed effects, when we do that, we see that this coefficient turns positive, and this is where we get our 32.9 percentage point higher returns per trade on average for experienced investors. But now let's dig a little bit further into this number. And first, let's recognize or document the fact that if we instead replaced on the right-hand side, we used a dummy for just whether or not the previous trade was a primary market transaction, whether or not that original purchase was a mint, we can see pretty clearly that the average return to trades that were originally mints is on average much higher, right? On the order of 300% percentage points higher return per trade for realized trades that were previously mints, right? So recognizing that, when we basically add whether or not a previous transaction was a mint to our fixed effects, essentially controlling for that aspect of the trade, we see that our outperformance drops all the way to 6 percentage points, meaning that 80% of that outperformance we just documented can be attributed just to the fact that experienced investors tend to mint a lot more often within their own trading activity. So let's now dive further into that 6% number. And one thing we can do is we can actually just separate out our sample and say, why don't we just run these regressions separately for mints and secondary market transactions. And here we document that, well, this outperformance is, so we're not controlling for is mint here, we're just within the set of mints. We see that experienced investors outperform by 9.3 percentage points on average. But if we look at secondary market transactions, here's where we see no outperformance at all. So now let's take this 9.3% number and let's take a little bit of a deeper look at that as well. We're essentially, in this table, we start with that finding. So we're within the set of mints, or set of realized returns that were previously mints. And when we add any sort of control for the collection, meaning we put in collection fixed effects, or we add collection fixed effects to our date buy by sell date fixed effects, we see that basically this outperformance completely drops away. And so this is why we say that the remainder of this outperformance seems to be due to the fact, or seems to be due to essentially collection level factors, which we argue would be that experienced investors appear to just pick better collections to mint. But this isn't the only way that we can actually document this. In fact, what we can do is we can look at the collection as a whole and try to define a variable that captures how much experienced investor interest there was. So that variable specifically is we take the number of investors, or I guess the volume of a minting period that was purchased by experienced investors, and divide that by the total. So giving you basically a share of the primary market that was composed of experienced investors. And we have just some simple bin scatter plots here that just pretty, it was visually make the point pretty clear that on this left one, we're looking at just whether or not a collection minted out if they just sold all their items. And we can see that this is clearly increasing in the fraction of experienced investors involved. And then on the right-hand side, we show that the days it took them to mint out. And here we see that this is also declining, meaning that collections with more experienced investors also sell out a lot more quickly. Right? So this is kind of obvious visually, but we do run the proper cross-sectional regressions with lots of other collection level controls and find that this variable still has a lot of predictive power. Thanks. So you can also look after the minting period and basically ask the same question, that if you take our fraction minted by experience and use it to predict pricing growth in the next period, either the next day, the next 7 days, all the way up to the next month, we once again see positive association between the fraction of experienced investors and this subsequent price growth in the secondary market. And here we're using our collection level price indexes that I described earlier. Okay, so the final result I want to show you, thinking back a little bit to that outperformance, and especially in the minting part, you may be asking, well, could it be due to the price they're receiving, or maybe they're getting cheaper mint prices? Well, here's where our gas data is actually interesting to look at, because what we see is that if we ignore gas paid and just look at mint prices, experienced buyers tend to pay the same amount for the items as compared to everyone else when you control for the collection. Now, when you actually look at price paid plus gas fee, you see that experienced investors actually pay more in the primary market on average in terms of their mint price. And our explanation would be that these experienced investors believe that this is a good collection, really want to get into it, and therefore are willing to pay a higher gas fee in order to make sure that they're part of the mint. All right, so let me just conclude. So in this paper, we document that experienced investors systematically outperform inexperienced investors. We document, the magnitude as well as decompose it into its parts. And once again, big picture, our evidence suggests that experienced investors are able to take advantage of the informational asymmetries in this NFT market. Thank you very much.
Which this one?
Yeah. Thank you so much. Okay, perfect. So thank you so much for the organizers for inviting me to discuss this very interesting paper. So I do have a personal interest in this. I minted an NFT for my daughter's digital art as kind of an educational project. We put it up on sale on OpenSea and it never sold. And now I know that we were not able to attract the experienced investors to buy that NFT. So, but I still have to market that a little bit better. Okay, so what do the authors do? They analyze NFT collections, which are computer-generated large collections of art pieces. They are first sold to initial investors in what's called the mint process, and then they go to a secondary platform like OpenSea and sell there. They collect all mints and trades on the Ethereum blockchain, and one of the interesting findings is that 3% of the wallets do 50% of the mints and trades in the collections, and so those are what are identified as experienced investors in the paper. So these experienced investors make an astonishingly 33% higher return than the inexperienced investors. Most of the outperformance comes from the primary market, or pretty much all the outperformance comes from the primary market. So most often this is because these experienced investors mint more often, but they also seem to have some selection, so they seem to have a better take at minting from the better collections. So interestingly, there's no outperformance in the secondary market of these experienced investors. And another neat finding of the paper is that the collections with the more experienced investors sell out faster and are more likely to sell out in the first place. So let's have a look at who are these experienced investors. And we might think of this as an art connoisseur who thinks that looks at the NFT and identifies that the bored ape is going to be more successful than the fatigued dog. But I would argue that it's much more likely that these experienced users are bots. So if you Google NFT bots, you find a lot of interesting websites. So there's the website of the 25 best NFT bots. There is this NFT bot trading company who looks at implementing your desired trading strategies in NFTs, but also going to the primary market and quickly acquiring the best NFTs. So this is more or less scalping, where you buy up all the NFTs of a collection very quickly by using an automated bot instead of really doing this manually. And of course, you can see why the bot has an advantage. Anybody who wanted to buy a graphics card in the last 2 years went through a lot of pain because of the scalpers. And we see, I think, a similar thing in the NFT market space. So there's even YouTube videos on how to build your NFT trading bot and how to make money in the NFT market with bot trading. So I would think that these active investors are not art connoisseurs, but trading bots. And so the interesting question is, why are bots profitable? It's still an interesting question to look at this. So one strategy is scalping. So you buy large scale at the minting, and then you have a bigger part of the collection, and then you want to sell them in the secondary market. It could be fake bidding. So there is at least rumors where people post fake bids, and sometimes the issuer themselves bids on their own collection to create artificial interest, and then people say, oh wow, these NFTs that Alfred put up there for sale really create a lot of interest, and then more people buy them. And so in truth, it's just me buying my own NFTs at high prices to boost up interest. So it could even be that issuers have agreements with bots. So one thing that we know is that in these markets, there is whitelisting, where you can go and whitelist the wallet address, and then this wallet address can buy the tokens in an ICO or NFTs at preferred terms. So they get a guaranteed allocation, and they might get a lower price. And by the way, in these kind of blockchains, everything is possible, right? Nothing is illegal. So we could even have side payments here, where the issuer hires a bot to come in, buy up part of the collection, trade them, bring up the price, and then sell the NFTs to the market for things that buys them at an overvalued price. Once the bots have a stake in the collection through this whitelisting, they obviously have an interest to bring the price of the NFT up so that they can sell them to somebody else for profit. So this is pretty much consistent with all the results in the paper, this alternative story that the bots make all the money in or the experienced investors make all the money in the primary market, because they get the allocation, because they get the discounted price, maybe because they get a side payment. And this in the secondary market, bots are not that successful in trading. So the question could be also, is it interesting if you market an NFT collection? Do you want to collude with a bot? Do you want to hire bots to do the trading for you so that you can actually sell out at some point in time for you? So we do see a lot of side payments actually on the blockchain. So you can hide payments in internal transactions on the Ethereum blockchain, and then they're not very obvious. So on Etherscan, they're not that easy to find. So you have to know very carefully where you look into, or you run your own get client and extract the internal transactions to catch these side payments. But we see a lot of these side payments happening actually on the Ethereum blockchain. So some other more technical comments. A lot of the tokens never trade in the secondary market, and then in the paper they use a pricing model where you regress prices on collection date fixed effects. So maybe I understand this wrong, but I think this only makes sense if you have more than one trade in a collection on a day. But then those days where there's more trades might be special days where something else happens. Maybe gas fees are lower than average or higher than average, or something else is going on, or a similar collection is in the market. So this would be interesting to analyze, see if there's anything going on. So the untraded NFTs are valued at the 25th percent quantile if there's at least more than 4 trades on a given day. And that might lead to some kind of unusual pricing as well. So in the paper, they look at fees, but are the proceeds that go to the artist also taken into account? So, okay, that was not clear to me. And the last kind of technical question was, why look at the returns when they, the holding period is used as a control variable in the regression? If we talk to our students about how to measure returns in the stock market, we usually tell them to analyze returns and not put the holding period as a control variable in there. So why that? Maybe there's a good reason for that. It would be interesting to know. So some other comments that this market is very unusual. These bots not only probably scalp the primary market, they also follow a lot of other different trading strategies. So one is wash trading, and one of the reasons for that is not only to inflate prices, but also to collect on airdrops. So Rarible drops their own token, gives them as a reward to anybody who trades NFTs on their platform. And so people, of course, figured this out, and then Andreas and I set up a little kind of Ponzi scheme where we just trade an NFT back and forth, and every time we do that, yeah, that's how we fund our flight here, right? So, then we collect these tokens, these airdrop tokens, and make some money along the way. So there's companies out there that exist to detect this wash trading. So this company, for example, I know about, they built a system to detect these wash traders, and they work with Rarible so that they don't get airdrops of token if they are caught doing this wash trading strategy. Other bot trading strategies are to drive NFT prices down and then buy the tokens. So one trick is to bid below the ask, and then when the bid accepts, the bot cancels the trade. So this way, the token is then held in escrow for a period of time, and then the new starting price is the lower price that was done by the bot. So the last accepted price is now lower, and the bot can bid a lower price and then buy the token and then sell it at a higher price later on. So there's all kind of weird strategies going on that potentially have an implication on the data. So I've also read on the internet that bots offer tokens in kind of an Amazon-like platform. And then when the buyer puts the token in the cart, that's when the bot actually buys the NFT on OpenSea and immediately sells it to the person in the cart. But if the bot doesn't buy the transaction, they cannot buy the NFT on OpenSea profitably to do so, then the kind of cart mysteriously fails and the transaction never goes through. So while the user waits for the transaction to process on the Amazon type platform, the bot buys the NFT on OpenSea. So we do see that these kind of strategies produce huge short-term returns for the bot, right? So for a zero holding period to make some money, that's an infinite return. And so this could also create some distortions in the data. So this is not only bots, so this is a wild market. So everybody probably remembers people's everyday collection for the first 5,000 days that went up for a $70 million sale. And the guy who bought this, apparently, I read on the internet, how much you can trust it, I don't know, but bought 20 other pieces from the same artist before the spectacular purchase for the $70 million. So through a bunch of proxies or middlemen. So the idea, of course, if you already own 20 pieces of the collection, then you make this huge publicity stunt by it. Not only it benefits your own holdings that you already have. So it doesn't have to be bots. This is could all be a lot of market manipulation. So this market is pretty much the Wild West, and there is a lot of crazy things going on, and that could potentially change the findings of the paper, that could potentially create very unusual outliers and strange returns. There's collusion between issuers and bots to drive up prices on purpose, and that could as well be what we see. So it would be interesting to see how this bot activity here influences NFT pricing. Okay, thank you very much.